Yeah, the 10-year is having an incredible day today. The yield has popped 10 or 11 basis points, and that's the biggest move since just after Trump was elected. I think back then it was like in the 20s, but this also reminds me of a move that we saw back in 2013 because that was the last time that July 5th, Jobs Day, came right after July 4th. So, kind of things are settling down here, lower volume day today, and I think it's just a situation ripe to inflict the maximum amount of pain on bond traders. Now, we've seen the 10-year yield go from down 130 some basis points to reach 1.95% on Wednesday. Now it's bouncing from that. And it's really been a case of searching for yield for investors. We have $12 trillion in global bonds, which are now negative. And just people trying to get, we were talking about this, you and I, earlier, especially pension funds. Where are you going to find that quality investment? And so all of that tends to drive down the price even more as more people flock into U.S. bonds, which are still positive, even adjusting for core PCE inflation. But that begs the question, what happens if and when bonds eventually do meet that point of 1.6, 1.7%, suddenly bonds, even in the U.S., are not as attractive anymore. We've seen incredible fund flows into bonds, not just in the U.S., but corporate bonds globally, and we have to wonder how long can this continue?